Hey, this is Justin from BreakIntoCRE.com, and in today's video, we're going to talk about how to know when to sell a commercial real estate property. So if you're thinking about trying to take advantage of today's sky-high prices in commercial real estate and want to know when the right time is to sell, make sure to stick around for this video. Now, if you're new here, on this channel, we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the industry or do your first or next commercial real estate investment deal, make sure to subscribe and hit the notification bell. Now, deciding whether or not to sell a real estate deal is a huge decision, whether you're an individual investor or a large private equity firm. So if you're considering selling a deal, this video is going to cover 5 important things that you need to take a look at before you decide whether or not you want to pull the trigger on marketing the property. Now, the first thing that you need to ask yourself when you're trying to figure out when to sell a deal is the question, what have I promised to my investors? Now, obviously, if you are an individual investor, this doesn't specifically apply to you, but if you've raised equity from investors, you need to think about what you've promised those investors from a return perspective and also from a hold period perspective. That means that you might be able to sell the property today at a 25% IRR when you only promised your investors an 8% IRR, but if your investors expected their capital to be out for 10 years and it's only been 2 years since you purchased the property, that may be something you need to step back and think about before you decide to list the deal. And this isn't only important to make sure that you are good on your word to investors, there's also a monetary component to this with promoted interest. So if you're going to wait a longer period of time to sell because you set that expectation for a longer hold period up front, you may have to weigh that with the risk of not hitting that promoted interest and having the market tank over the next 3 to 5 years. And speaking of things not going as planned on your deal, the second question to ask yourself is what lease expirations are coming up in the next few years. Now, for multifamily properties, this generally isn't all that important since you'll usually have short-term 6 to 18-month leases, and you'll likely have dozens, if not hundreds of different tenants that are going to roll over on a consistent basis. But for retail, office, and industrial properties, especially for deals that only have a small handful of tenants, this can be a really huge deal to your cash flow. Lease expirations could mean costly months of downtime, thousands of dollars in leasing commissions, and thousands of dollars of tenant improvement allowances just to get the suite back up and running. And if you're investing in real estate for cash flow, these big vacancies and tenant improvement allowances and leasing commissions can significantly impact that cash flow for months or even years, and you may even have to go back to equity investors or your own pocket to fund those tenant improvements and leasing commissions if the tenant is a large enough percentage of your leasable area. And if you have a lot of turnover coming up and that's not something that you want to deal with and go through as an investor, you may want to think about listing the property at that point and selling to an investor that can see that upside in the deal and is also well capitalized and can fund those tenant improvements and leasing commissions to get that property up and running again. Now, once you've taken a look at your upcoming lease expirations, the next question that you want to ask yourself is, have I maximized the value of this property to the best of my ability? So you may be ready to sell from a pure timing, numbers, and even an emotional standpoint, but is there more meat on the bone, and could you add additional value without a significant amount of work? For example, even small things like cleaning up a delinquent tenant base on a multifamily property or doing things like repainting buildings or repaving parking lots can add a lot of value to your property when you go to sell, and many of these things can be accomplished in 6 to 12 months, and the return on investment is huge when you're doing the right things. Especially if you're trying to position your property to sell to an investor that's looking for cash flow, getting rid of some of the smaller capital items and headaches that the next buyer won't have to deal with is going to be huge in increasing the value of your deal. Now, if you've taken care of all of this and you feel confident that you've maximized the value of your property, the fourth question you want to ask yourself is, what would I do with the sale proceeds if I were to sell this property? And if you sell your property, a few things can happen. Specifically, you can either 1031 exchange into a new property and defer your capital gains taxes, or you can cash out from the property and pay capital gains and depreciation recapture tax. And while many people get excited about the concept of a 1031 exchange, if you're selling a property in a hot market, you're also going to be buying a property in a hot market, and you'll also be under the pressure of time constraints as well. So before deciding that you want to sell and you'll 1031 exchange that into another property, you need to make sure that there's going to be another property that you're going to be excited about investing in. You'll also need to take into account transaction costs, which can be extremely costly on the sale side, but also through that 1031 exchange. So you want to make sure that you're not letting the tax tail wag the dog by investing in a deal that you don't totally believe in just for the sake of deferring your tax bill. And if you don't plan to defer your tax bill and you plan on cashing out and paying those capital gains taxes and that depreciation recapture tax, you need to ask yourself, what are you going to put that money into? So you were already invested in a piece of real estate that was generating income. How are you going to replace that income or replace that annual growth that you saw from your real estate deal, assuming it was a good one? Make sure that you have another investment vehicle that you feel strongly about, and make sure that you have vetted that investment vehicle thoroughly. There's a saying that says the devil you know is better than the devil you don't, and this is often the case here, where even though you might have a troublesome real estate property, it may be more beneficial to hold on rather than moving to a new investment vehicle and dealing with the stress and headache of making sure that you're choosing the right thing. And last but not least, the last question that you need to ask yourself is there another way to change this situation without selling? So this is most applicable when you have a troublesome property that you're trying to get rid of, or you don't want all of your money locked up in this one specific real estate investment. So if you're having issues with property operations, is there another property management firm that you could hire that could take away a lot of the day-to-day stress? And if you're tired of managing the leasing, could you hire a third-party asset manager to take that on for you? And if you want to get cash out of the property, could you consider a cash out refinance rather than selling the deal? There has been tremendous wealth grown over time by buying and holding real estate long term, and oftentimes increasing that value and your overall net worth is just about being able to hold on longer than the next guy. So whatever your goals are, there are likely a lot of different options that you have aside from selling the property, so make sure that you really want to get out of the deal before you decide to list the property. Now, if you're a numbers person and want to know the technical analysis behind this to make sure that you're making the right decision and selling at the right time, I'd highly recommend checking out my course, the Advanced Real Estate Financial Modeling Bootcamp, and that's going to show you exactly how to run a hold-sell analysis in Excel to figure out how you can maximize your returns based on the year that you're selling the property. So I'll leave a link to that in the description below. And if you're just starting to learn about real estate financial modeling and you're not ready for an advanced course, check out the free Break Into CRE Real Estate Financial Modeling Crash Course, and I'll link that in the description as well. So I hope that was helpful. If you like this video and want to see more content like this around deal analysis, make sure to let me know by hitting the like button, subscribe to the channel, and share this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.